was at 363.
All right. Now, thanks very much for that, for running our viewers through those ideas. Sunil Subramaniam, who's CEO Sundaram Mutual Fund, joins in with his perspective on the market. Sunil, it's great to have you on the show. How are you sizing up the opportunity that May would throw up for the markets? Most of the earnings have pretty much been digested among the large caps, that is. What trend do you spot for this month as well as the near term?
I think there's going to be volatility this month and the near term, primarily because the election results, which next week should get clarity on that. But as you know, there's lots of news happening on the international front also in terms of trade, tariff, and Mr. Trump. So from the perspective of the market, what we are doing is to increase the defensive component of the portfolios, namely focusing a little more on the consumption as well as on IT. These are the two sectors which we believe will be defensive in this volatile time and would help protect the downside, because there is good news coming out both in terms of the consumption earnings footprint, as you saw, and the rupee depreciation and the IT. The fact that digital spends are going up in the North America and Europe means that it's good news from an IT perspective. So I think this is a time where we are focusing a little more on the defenses, though from a 3 to 5 year perspective we continue to remain bullish on the Indian economic growth story and infrastructure and the related sectors which are going to benefit from that.
Sunil, wanted to understand what is it that you've made of iShares' performance and more importantly how one should approach these kind of expensive stocks. So while growth may be in their side, margins could have been a little bit better and there is that one-time hit also that they've taken, but largely growth remains intact. But what about valuations? Because that really is the concern in the market now on whether or not at the current valuations all the growth visibility also seems to be priced in.
Well, I can't talk on stock specifics, sure, but overall in the auto pack, the top line numbers, as you mentioned, are coming out strong, and bottom line there is varied impact. So for us, the key is the top line, because ultimately the capacity utilization in the country is getting used up, and that's good news overall. So we are not really concerned about the valuation. Stock specific, yes, there may be issues, but overall on the consumption pack itself, valuations are fairly reasonable and the numbers have justified it. So for us, I think this is not a time to get concerned on these numbers. I think we continue to stay holded through these high valuation sectors at this moment, because the economic footprint is good and supportive of these exposures.
Right. So then give us your sense, which are the themes that you are most favoring in the market, and how you in specific looking at the story on oil prices extending themselves out?
Yes, so basically one on the story, like I said, for us the big story is consumption and IT. We believe that consumption especially will be driven more with a rural tilt. Two reasons for that is, one is of course it's an election year, so with all these elections spends in rural India goes up. Second is the monsoon outlook so far from both the forecasters, SkyMet and India Met, has been positive in this year's monsoon. So we believe that that's where the bets need to lie in terms of the consumption. And IT, as I already mentioned to you, the initial part of the way over the last, we've been bullish on IT at the mid-cap space for quite some time now, and those numbers actually came through and justified it, and the valuations have consequently gone up. Now what's happening is this initial digitalization move, which is what drove the mid-cap IT pack, right, the order books from there, are now the larger companies are also, as you've seen from the results, be able to back those big orders on the digitalization. So we believe that IT, along with the rupee depreciation, which is what oil prices have done to the rupee, is going to be beneficial to that sector. So we believe the bets, as short-term bets are, as I said, rural-oriented consumption and IT. And in the medium term, we see that the economic footprint coming through means that capacity utilizations are gradually going up. So we expect that overall Indian corporate sector capacity utilization in say 9 to 12 months from now should be closer to 80% as opposed to the mid-70s over the last 2 years. So this at 80% level, you will see fresh interest on specific sectors putting up fresh capacities. This will be a spin-off effect for mid-sized capital companies, EPC contractors, and overall for both the cement and the steel pack. So we are bullish on both cement and steel as infra plays, because by about 2020 we see that country is actually going to run short on the steel pack. So this is the way we are constructing our portfolios, 40 to 50% on the defensive sides and 30 to 40% on the cyclical side. And on oil price specifically, yes, naturally there will be an impact in terms of corporate India, of those who are oil intensive in terms of sectors. Their margins will come under pressure. The only flip side to that is that shale gas production is now on in full swing, and already incremental supplies of crude oil into the market. The OPEC pack is trailing the shale goods pack from Americas. So that supply, we believe, will keep a kind of a tab on oil, not going to 100, 120 kind of levels, but an elevated price of 70 to 80 itself will have its impact. And given that it's an election year, the government is unlikely to pass it on fully to the consumer. So inflation, and we're not so worried. But yes, corporate India will have to absorb those increased costs. And definitely we are not so bullish on the oil marketing companies, because their refining margins are probably going to be little under pressure.
Okay, fair point. So crude aside, Sunil, tell us, what is it that you've made of some of the consumption trends in light of Titan's numbers today and the kind of, comments that we've already heard from the management with regards to their jewelry as well as the watches business, and how they feel that e-commerce is also going to be a big leg up to the watches segment. And jewelry continues to do well as it would, and now they're betting big on affordable diamond jewelry as well. What is it that you're hoping to hear from Titan today? And I know you can't talk stock specifics, so just your thoughts on urban consumption trends.
We believe that the rise in per capita income has been pretty strong in India. In the coming years, it's probably going to double in the next 3 years. Given that there's a big shift from a basic necessity kind of goods to a lifestyle oriented goods, and I think jewelry, especially the modern kind of jewelry to Western wear, that is complementing Western wear, where diamonds and platinum play a part, we definitely see a very strong bullish trend. And yes, e-commerce, because of the new age generation, would like to buy stuff at the click of a button. So these are all very positive trends, which I think is going to shift the consumption pattern away from basic rice, commodity, hair oil, coconut shampoos into these kind of fabrics. The other sector which will benefit along with this will be consumer durables. So I think high-end purchases wherever they are. And like I mentioned again, rural India is no longer an agrarian, entirely monsoon dependent farmer kind of a thing. Rural India is urbanizing, the urbanization program. So you will see all these modern things like jewelry and all of that will also catch up at a much faster pace in semi-urban and rural India. And this is going to affect companies like the ones you mentioned, across the board in a very positive way. So we remain positive and expect to hear some very positive outlook for the current year from the set of high-end consumption companies.
How are you looking at the export-oriented themes right now in IT and pharma?
IT, as I mentioned, we are very bullish. Export-oriented services exports, we are very bullish, because we believe that India has the skill set, the capacity, the English language skills, the turnaround, the people strength, the younger population, all of that should help the services pack outperform on the export side. On the manufacturing exports, I think what we need is for the Make India program, the FDI program to really come through, and big investments have to come from foreign investment. So without foreign investment coming in, we don't see that our manufacturing exports, given the technology, given this current state of play on the overall manufacturing sector, we believe a fresh injection of FDI and foreign investment is necessary, where India can be a brilliant thing in terms of these SEZs and all export oriented. So if foreign manufacturers come in using India's land, resources, people to re-export out of India, that's the kind of story we believe is going to play out very, very strongly. Pharma, we remain very sectorally neutral. We are not very bullish overall on the pharma pack, but there are selective stocks or things which, based on their positioning in terms of whether generics or specific manufacturing, that we are looking at. But overall, on the pharma pack itself, we are underweight to the market.
Okay, great speaking with you, Sunil. Thanks so much for taking time out and chatting with us today. Quick look at the market, status quo really. We continue to lie flat when it comes to the index. ONGC, Bharti, Z ahead of its numbers holding out. There's HDFC Bank as well, which is seeing just mild bit of strength, up by about 0.6%. The broader market continues to reel under pressure. Federal Bank has lifted off from the lows of the day, but just by about 1%. It's still languishing by 9.6% in the futures. Jindal Steel is down. There's HCC, which is down, and JP Associates also taking a knock of about 4.5%.